Gold reaching record highs and silver breaking above the critical 90 level is not just another routine market move. It is a historic signal that something fundamental is shifting beneath the global financial system. These kinds of breakouts do not happen in isolation, and they do not happen without powerful forces driving them. When both gold and silver surge simultaneously, especially to levels never seen before, it usually marks the early stages of a much larger economic transition. For decades, gold has been considered the ultimate safe haven asset. It performs best when confidence in paper money weakens, when debt spirals out of control, and when investors start questioning the stability of governments and financial institutions. Silver, while also a precious metal, plays a dual role, part monetary metal and part industrial commodity. When silver explodes upward alongside gold, it often signals not only fear in the financial system, but also deep stress in supply chains, energy markets, and industrial demand. The recent move is especially important because it comes at a time when traditional markets appear calm on the surface. Stock indices may still be holding up, and official economic data may suggest stability, but gold and silver are telling a very different story. These metals are reacting to realities that are not fully reflected in headlines: rising global debt, currency debasement, persistent inflation pressure, and growing geopolitical uncertainty. Precious metals tend to move first, long before the broader public realizes what is happening. Silver breaking above $90 is a psychological and technical milestone. For years, silver traded far below its historical value relative to gold. Many analysts argued it was undervalued, suppressed, or structurally constrained by paper markets. A breakout at this level suggests that those constraints are weakening. It indicates physical demand is tightening supply, and investors are no longer satisfied with paper promises. When physical demand begins to overpower financial engineering, price discovery accelerates rapidly. Gold's record high, meanwhile, reflects a global loss of confidence in fiat currencies. Central banks around the world have been expanding balance sheets, monetizing debt, and quietly accumulating physical gold. While official statements often downplay risk, central bank behavior tells the real story. They are preparing for a future where trust in paper currencies may erode further, and gold once again becomes a cornerstone of monetary stability. What makes this moment especially dangerous, and potentially profitable, is that most retail investors are still unprepared. Many are heavily exposed to stocks, bonds, or currencies that depend on low interest rates and endless liquidity. Gold and silver, by contrast, thrive when those assumptions break down. The current breakout suggests the system is under more strain than it appears, and smart money is already positioning accordingly. This is why the phrase, "something big is coming," is not exaggeration. Historically, major moves in gold and silver have preceded currency crises, debt restructurings, banking stress, or major shifts in monetary policy. These metals are not reacting to rumors. They are reacting to math. Debt levels are unsustainable, real interest rates remain fragile, and confidence is slowly leaking out of the system. Section 1 establishes the core reality. This is not just a rally, and it is not random. Gold and silver are flashing a warning signal, and ignoring it has historically been very costly. Gold does not move to record highs without a reason, and it certainly does not do so because of short-term speculation alone. Every major bull move in gold throughout history has been driven by a collapse in confidence, not always visible on the surface, but deeply rooted in the structure of the financial system. The current breakout to record levels is a direct reflection of long-term pressures that can no longer be contained. At the center of this move is the global debt problem. Governments across the world are carrying debt levels that would have been considered impossible just a decade ago. Trillions of dollars have been borrowed to sustain economic growth, support markets, and prevent recessions from turning into depressions. The problem is not just the size of the debt, but the cost of servicing it. As interest rates rise even modestly, governments are forced to choose between fiscal pain and monetary debasement. Historically, they always choose debasement. This is where gold enters the picture. Gold is not someone else's liability. It cannot be printed, diluted, or defaulted on. When policymakers are trapped between inflation and insolvency, gold becomes the ultimate escape valve for capital-seeking safety. Investors who understand this are not waiting for official announcements. They are positioning early, and gold prices are reflecting that reality. Another critical factor driving gold higher is the silent but aggressive buying by central banks. While public narratives often focus on stability and control, central banks themselves are acting defensively. Over recent years, many have increased their gold reserves, reducing reliance on foreign currencies and U.S. treasuries. This is not accidental. It signals preparation for a future where currency systems may be less trusted and geopolitical alignments more fragmented. Currency debasement is also playing a major role. Even when inflation appears to cool temporarily, the purchasing power of money continues to erode over time. Real interest rates, the return after inflation, remain historically weak. When savers realize that holding cash guarantees a loss of purchasing power, capital flows into hard assets. Gold, being the most liquid and universally recognized hard asset, naturally benefits first. What makes this moment especially dangerous for unprepared investors is that gold is rising while many still believe inflation is under control. This disconnect often appears before major economic stress becomes visible. Gold tends to front-run reality. It responds not to headlines but to underlying monetary conditions. By the time inflation resurfaces or financial stress becomes obvious, gold prices are usually much higher. There is also a psychological component. Markets are built on trust. Trust in institutions, currencies, and policymakers. Once that trust begins to crack, even slightly, it creates a feedback loop. Rising gold prices attract more attention, which draws in more capital, which further validates the original concern. This self-reinforcing cycle is difficult to stop once it gains momentum. Importantly, gold's record highs are not signaling optimism. They are signaling caution. They suggest that large pools of capital are preparing for instability rather than growth. This is not about chasing returns. It is about preserving purchasing power in an environment where traditional financial assumptions are breaking down. In short, gold is not rising because the world is strong. It is rising because the system is fragile. Record highs are a warning, not a celebration. And historically, when gold sends such a warning, ignoring it has proven to be one of the most expensive mistakes investors can make. Silver crossing the 90 mark is more than a psychological milestone. It is a signal of extraordinary market dynamics that are rarely seen. While gold often dominates headlines as the ultimate safe haven asset, silver is equally important, albeit with a more complex dual role. Unlike gold, silver is heavily used in industrial applications, including electronics, solar energy, and medical equipment. This industrial demand creates a structural scarcity that makes silver highly responsive to both economic stress and technological growth. Historically, silver has traded at a fraction of gold's value, despite being equally essential in monetary and industrial contexts. For decades, paper markets, manipulation concerns, and investment apathy suppressed its price. But breaking above $90 demonstrates that physical demand is now overpowering financial constraints. Investors, realizing that silver is undervalued relative to gold, are actively positioning themselves, forcing price discovery in the open market. The current surge is being fueled by multiple converging factors. First, geopolitical uncertainty is pushing capital into tangible assets. When tensions rise, investors seek protection, and silver is both a tangible asset and a liquid investment. Second, supply constraints are becoming pronounced. Unlike gold, which is largely mined independently as a primary product, a significant portion of silver comes as a byproduct of mining other metals like copper, zinc, and lead. When production of these base metals slows due to environmental regulations, geopolitical issues, or mining economics, silver output is inadvertently restricted. This supply inelasticity amplifies upward price pressure. Industrial consumption is another critical driver. Renewable energy adoption is accelerating, and silver is an essential component of photovoltaic cells. The electric vehicle revolution further compounds demand for silver in battery and electronic components. These trends indicate that industrial demand is unlikely to weaken in the near term, meaning that a growing portion of newly mined silver will be consumed in permanent applications, reducing the amount available for speculative or investment purposes. Investment demand is exploding alongside industrial use. ETFs, physical coins, and bars are being accumulated at record rates. Hedge funds and institutional investors are taking positions based on the historically elevated gold-to-silver ratio, betting that silver will catch up to gold in value. The rapid inflow of investment capital is creating a feedback loop, where rising prices attract more buyers, which then pushes prices even higher. Another aspect driving this surge is the tightness in the physical market. Premiums for silver coins and bars are widening globally, reflecting the scarcity of immediate supply. Paper contracts and futures markets may suggest availability, but actual physical delivery is constrained. This disconnect between paper markets and physical supply signals that investors are now competing for real, tangible silver, adding a layer of urgency to the rally. Silver's role as a dual-purpose asset makes it especially sensitive to macroeconomic shifts. In times of uncertainty, it behaves like gold, preserving wealth and confidence. Simultaneously, as an industrial metal, it benefits from structural growth trends. This unique combination creates explosive potential for price movements, as observed in the recent breakout above $90. Finally, the psychological impact cannot be understated. Crossing such a milestone generates media attention, retail interest, and speculation. The narrative of scarcity and opportunity reinforces itself, attracting further investment. Silver is not just rising in response to fundamentals. It is rising because the market collectively recognizes its undervaluation and strategic importance. In conclusion, silver breaking $90 is a multi-layered signal. It reflects industrial demand, structural scarcity, safe haven positioning, and investor psychology all converging simultaneously. Understanding this dynamic is crucial for anyone seeking to navigate the current precious metals market effectively. Those who recognize these forces are likely to be well-positioned as silver continues to test new highs in the coming months. The role of global debt and economic stress in the precious metals. Surge. The simultaneous rise of gold and silver to record highs is closely tied to global debt levels and the increasing fragility of the financial system. Debt across developed and emerging economies has expanded to unprecedented levels over the past decade. Governments have relied on borrowing to sustain growth, fund infrastructure, and stabilize markets during crises. However, this surge in debt comes with consequences, particularly in periods of rising inflation and interest rate uncertainty. Investors are increasingly aware that high debt-to-GDP ratios create systemic vulnerabilities. When debt levels become unsustainable, governments and central banks have limited options. Either they implement austerity, risking recession and social unrest, or they pursue monetary expansion, effectively devaluing currency. In both cases, precious metals benefit. Gold and silver act as hedges against currency erosion and financial instability, providing a tangible store of value when confidence in paper assets falters. Interest rates also play a pivotal role. Historically, gold performs best in low or negative real interest rate environments because it has no yield. When the cost of holding cash or bonds fails to keep pace with inflation, investors flock to assets that maintain purchasing power. The expectation of slower rate hikes or potential rate cuts in major economies has intensified this shift toward precious metals. Silver, while more volatile, mirrors these movements and often amplifies them due to its dual industrial and investment demand. Geopolitical tensions compound the situation. Trade disputes, regional conflicts, and political uncertainty create additional pressure on financial markets. In such an environment, capital naturally moves towards safe haven assets. Investors no longer trust the stability of equities or fiat currencies alone, and the result is a surge in both gold and silver prices as risk-off behavior accelerates. Central banks themselves are playing a major role in the dynamics of these metals. Many institutions are quietly increasing their gold reserves, a clear indicator that even those with deep market knowledge are hedging against systemic risks. These accumulations create a scarcity effect, amplifying upward price momentum. The combination of public uncertainty, institutional accumulation, and physical scarcity has created a perfect storm for the recent breakout. Another critical factor is the psychological behavior of markets. When one precious metal rises sharply, it draws attention to others. As gold hit record highs, silver's underappreciated value became evident, encouraging both retail and institutional investors to reposition portfolios. This behavioral response reinforces the rally and creates self-reinforcing upward pressure on prices. Moreover, industrial demand for silver, which cannot be ignored, continues to grow even as investment demand rises. Solar panels, electronics, medical devices, and emerging technologies require silver, tightening the supply available for speculation. Physical availability is limited, and as a result, premiums for immediate delivery of coins and bars have spiked in several markets worldwide. This scarcity drives prices higher, particularly in moments when both gold and silver markets react simultaneously to macroeconomic stress. Finally, this surge reflects a deeper systemic message. The traditional financial system is under pressure, and the flight to tangible, reliable assets is accelerating. Investors who recognize the convergence of debt stress, low confidence in fiat, geopolitical risk, and industrial demand for silver are likely to understand that this rally is not temporary. The breakout is both a warning and an opportunity, a signal that wealth preservation and strategic positioning are now more critical than ever. Investor behavior and market psychology. Behind the rally. The recent surge in gold and silver is not just a response to tangible financial factors, it is also a reflection of deep-seated investor psychology. Markets are ultimately human constructs, and they respond to fear, uncertainty, and greed. When both gold hits record highs and silver breaks the $90 barrier, the psychological impact on investors cannot be overstated. Fear is a major driving force. When traditional financial instruments, such as equities and bonds, fail to offer security against inflation or systemic risk, investors naturally seek assets that can preserve wealth. Gold has historically filled this role, providing a reliable store of value in times of crisis. Silver, while more volatile, is increasingly recognized as both a safe haven and a speculative opportunity, amplifying the psychological effect. Greed, conversely, drives momentum. Once prices begin to surge, attention from the wider public and retail investors intensifies. Social media, financial news, and online trading platforms amplify the perception that something big is happening, which creates a self-reinforcing cycle. As more investors seek to capitalize on the rally, prices accelerate further, often beyond fundamental valuations. This behavior explains why silver, with its smaller market capitalization relative to gold, tends to move more sharply during breakout periods. Herd behavior is also evident in the current environment. Investors frequently follow the actions of institutional players, such as hedge funds and central banks. Large-scale purchases by these entities create a signal that the market is entering a new phase, encouraging retail and smaller investors to follow suit. This collective movement increases liquidity, but it also creates short-term volatility, which traders can exploit while long-term investors position for sustained growth. Market sentiment is further shaped by narratives. The idea of a hidden financial crisis, monetary debasement, and systemic risk has captured the imagination of both professional and amateur investors. Headlines emphasizing record highs and historic breakouts trigger cognitive biases, such as loss aversion and fear of missing out, FOMO. These biases accelerate capital flows into precious metals, reinforcing the rally and creating a psychological feedback loop that drives prices higher. Another factor is the scarcity mindset. Physical availability of silver and gold is limited, particularly in coins and bars for immediate delivery. Investors are increasingly aware that paper markets may not reflect true supply constraints. This recognition leads to panic buying and hoarding, further amplifying upward price momentum. The perception of scarcity often outweighs actual supply-demand dynamics, particularly when both metals are rallying simultaneously. Institutional behavior adds another layer of complexity. Large financial players, aware of the systemic risks, strategically accumulate positions in gold and silver to hedge portfolios against potential crises. Their sophisticated strategies, combined with market opacity, can cause sudden price spikes, which retail investors interpret as signs of opportunity. The interplay between institutional accumulation and public attention creates an environment ripe for sharp movements in both metals. Finally, psychological resilience is becoming a factor among experienced investors. Those who understand historical patterns recognize that rallies like this are often precursors to broader market shifts. They position carefully, balancing speculative exposure with long-term wealth preservation. This deliberate behavior contrasts with the impulsive responses of uninformed investors, yet both groups contribute to the volatility and visibility of the rally. In conclusion, investor psychology is as powerful as economic fundamentals in driving the current surge. Fear, greed, herd mentality, scarcity perception, and institutional behavior all converge to create an environment where gold and silver can experience unprecedented gains. Understanding these psychological drivers is crucial for anyone aiming to navigate the current precious metals market successfully. What this rally means for investors and the road ahead. The historic surge in gold and silver prices is more than just a short-term opportunity. It represents a fundamental shift in the global financial landscape. Investors observing these moves must understand that the breakout is both a warning and a potential wealth-building window. Ignoring these signals can result in significant opportunity costs, while thoughtful positioning can yield both protection and profit. One of the primary implications of this rally is the reaffirmation of gold and silver as safe haven assets. In an era of record global debt, uncertain monetary policy, and geopolitical tensions, tangible assets like precious metals provide stability and preserve purchasing power. Investors who recognize this are increasingly allocating portions of their portfolios to gold and silver, balancing risk across asset classes. Diversification is no longer just an option. It is becoming a necessity for those seeking financial security. Silver's unprecedented rise above $90 also highlights the metal's unique dual nature. Unlike gold, silver has significant industrial applications, which add structural demand beyond investment flows. Renewable energy, electronics, and medical industries consume large quantities of silver, reducing the available supply for market speculation. As industrial demand remains robust and physical scarcity persists, silver has the potential to accelerate even faster than gold in the coming months. Market dynamics indicate that central bank behavior will continue to influence price trajectories. Institutions are quietly accumulating precious metals to hedge against currency debasement and systemic risks. Their strategic positioning, often invisible to retail investors, creates scarcity in the market and reinforces upward momentum. Awareness of these movements is essential for individual investors who aim to align with larger financial trends rather than be caught off guard. Another critical aspect is timing and risk management. While the rally is strong, markets can be volatile, particularly in metals that respond to macroeconomic signals. Investors must combine technical analysis, historical patterns, and macroeconomic insights to make informed decisions. Understanding when to enter and exit positions, how much to allocate, and which instruments to use, whether physical bars, coins, ETFs, or futures, can greatly influence outcomes. Psychological preparedness is equally important. The current rally is as much about perception as fundamentals. Fear of missing out drives aggressive buying, while fear of loss can trigger panic selling. Investors who maintain a disciplined approach, grounded in research and historical precedent, are more likely to benefit from long-term trends while avoiding emotional traps that can erode returns. Looking forward, analysts suggest that gold could test levels above $5,000 per ounce if current conditions persist, while silver may challenge the $100 threshold. These projections are not mere speculation. They are based on debt sustainability models, inflation trends, currency stability, and physical supply constraints. For investors, this implies that strategic accumulation now could position portfolios to benefit from extraordinary gains. Finally, the overarching lesson is that financial markets are signaling something significant. Gold hitting record highs and silver surpassing $90 simultaneously is a rare event that combines systemic risk, investor psychology, and industrial fundamentals. For those who pay attention, the rally represents both protection against an unstable financial system and an opportunity to grow wealth. Ignoring these signals could be costly. Responding wisely could be transformational. In conclusion, the gold and silver breakout is a historic moment. Investors who understand the convergence of global debt, industrial demand, central bank activity, and market psychology will be best positioned to navigate the risks and opportunities ahead. Strategic allocation, disciplined investment, and awareness of market signals are the keys to capitalizing on this unprecedented rally. Those who act with foresight will not only preserve wealth but could also achieve significant financial gains as the metals continue their upward trajectory.